Value investing is a strategy focused on identifying undervalued stocks that are trading for less than their intrinsic value. It's a bit like bargain hunting in the world of stocks. Imagine walking into a store and finding a high-quality item marked down to a price far less than it's worth. That's the essence of value investing. But instead of items in a store, we're talking about companies on the stock market. The idea is to buy these stocks at a discount and hold on to them until their true value is realized by the market, leading to potential profits. And who better to learn this art from than the master of value investing himself, Warren Buffett. Warren Buffett, the CEO of Berkshire Hathaway, is a prime example of a successful value investor. His philosophy is one that's simple, yet highly effective. It's all about investing in what you know. Buffett believes in the importance of understanding a business inside and out before putting money into it. He also looks for companies with strong leadership, those helmed by executives who have a proven track record of making sound decisions that drive growth and profitability. Buffett's philosophy places a high emphasis on the long-term potential of a business. He's not interested in quick, short-term gains. Instead, he seeks out companies that have a durable competitive advantage, a unique selling point that sets them apart from their competitors. And the price? Buffett only invests when the price is right. He's always on the lookout for quality businesses trading below their intrinsic value. So the bottom line of Buffett's philosophy is, invest in businesses you understand, with long-term potential, strong leadership, and a competitive edge, all available at a price that makes sense. The key to value investing is understanding a company's intrinsic value. This is the value that is inherent in a business, separate from its market price. It's a measure of what a company is really worth, based on its fundamentals. Now, you might be wondering, how does one determine this intrinsic value? Well, there are several ways. One of the most common methods is to analyze the company's financial statements. This includes looking at the company's earnings, its assets and liabilities, and its cash flow. But it's not enough to just look at the numbers. You also need to understand the company's business model. How does it make money? What are its competitive advantages? Additionally, you need to consider economic factors, such as the state of the economy and the industry in which the company operates. Remember, it's not just about picking cheap stocks, it's about finding quality. Scene script. Patience is central to Buffett's strategy. In the fast-paced world of investing, where quick returns often take center stage, this might seem counterintuitive, but remember, we're talking about value investing, a strategy that inherently requires a long-term perspective. Think of it this way. Value investing is like gardening. You can't just plant a seed and expect a fully grown tree the next day. It takes time for the seed to sprout, grow, and eventually bear fruit. The same principle applies to value investing. Once you've identified and invested in undervalued stocks, you have to give them time to grow and realize their true value. This is where patience plays a crucial role. Warren Buffett didn't become one of the most successful investors overnight. His strategy involved holding on to his investments for years, even decades, allowing them to compound and grow. It's not about timing the market, but rather about time in the market. Of course, patience must be coupled with diligent research and analysis. It's not about waiting aimlessly, but about confidently holding on to your investments because you've done your homework and you believe in the long-term potential of these companies. There's another side to patience in investing, one that involves resisting the temptation to follow the crowd. It's easy to get caught up in the latest investment trends and hot stocks. But value investing is about staying true to your strategy, even when it seems like everyone else is doing something different. Remember, the market can be irrational in the short term, causing stocks to be overpriced or underpriced. But in the long run, the market will recognize a company's true value. This is the essence of Buffett's investment philosophy, investing in fundamentally strong companies and patiently waiting for the market to catch up. Buffett's success has been built on holding stocks for decades, benefiting from compounding returns and the growth of fundamentally strong companies. In the world of investing, patience isn't just a virtue, it's a strategy for success. Risk management is crucial. When it comes to investing, it's not just about the potential for high returns. It's equally, if not more important, to consider the risks involved. After all, the ultimate goal is to grow wealth, not lose it. Warren Buffett, a master of risk management, offers valuable wisdom on this subject. Buffett's first rule of investing is simple: don't lose money. And the second rule, never forget rule number 1. It might sound a bit cheeky, but it's a fundamental principle that underscores the importance of risk management in investing. One of the key ways Buffett manages risk is by steering clear of debt. He is famously averse to borrowing money to invest. Why? Because debt magnifies losses as well as gains. If an investment doesn't pan out as expected, debt can turn a setback into a disaster. It's like playing poker with borrowed money. If the cards don't fall your way, you're left with a debt that you may struggle to repay. In contrast, if you invest with your own money, your losses are limited to what you put in. Sure, no one wants to lose their investment, but at least you won't be left owing money you don't have. This approach might limit your potential gains, but it also significantly reduces your risk. And that's a trade-off Buffett is willing to make. Another crucial aspect of Buffett's risk management strategy is the concept of a margin of safety. This means buying stocks at a price well below their intrinsic value. This cushion protects investors from bad luck, unexpected events, or errors in their analysis. It's like buying a house for $100,000 that you believe is worth $150,000. Even if you've overestimated its value, and it's only worth $120,000, you're still in profit. The margin of safety principle is a potent tool for reducing risk. It doesn't guarantee a successful investment, but it does provide a buffer against losses. And in the unpredictable world of investing, that buffer can be the difference between success and failure. In conclusion, risk management is an integral part of Buffett's investment philosophy. He avoids debt and insists on a substantial margin of safety when buying stocks. These strategies help to minimize losses, safeguarding his portfolio from the inevitable ups and downs of the market. Buffett advises against using debt to invest and emphasizes the importance of a margin of safety, buying at a price low enough to ensure minimal downside risk. In the end, successful investing isn't just about picking winners. It's about managing risks so that you live to invest another day. While diversification is a common investment strategy, Buffett favors concentration in a few well-chosen stocks. This is a philosophy that has been central to his investment strategy. When we talk about diversification, we refer to the practice of spreading investments across a wide variety of assets, from stocks and bonds to commodities and real estate. The idea is to reduce risk by not putting all your eggs in one basket. If one investment performs poorly, others may perform well, balancing out the overall performance of your portfolio. However, Buffett takes a different approach, one that leans more towards concentration rather than diversification. He believes in the philosophy of know what you own and why you own it. Instead of spreading his investments thin over hundreds of companies, Buffett prefers to place substantial bets on a few companies he understands deeply and believes in strongly. Now, this doesn't mean Buffett completely disregards diversification. He acknowledges its value, especially for novice investors or those without the time or knowledge to deeply analyze individual companies. But for those willing to do their homework, Buffett suggests that a more concentrated approach might yield better results. This philosophy stems from his faith in value investing. Remember, value investing is about finding companies that are undervalued by the market, but have strong fundamentals and a promising future. Once Buffett identifies such a company, he doesn't hesitate to invest significantly. He once said, "Diversification is protection against ignorance. It makes little sense if you know what you're doing." By this, he means that if you've done your research and are confident in the value and potential of a company, why not back it up with a substantial investment? However, this approach also requires a high degree of patience and confidence. Concentrating your investments can lead to greater volatility. Your portfolio's performance will be closely tied to the performance of a few stocks. That's why it's crucial to be confident in the companies you're investing in and be patient enough to wait for the market to realize their true value. It's also essential to understand that Buffett's approach isn't for everyone. It requires a deep understanding of businesses, a willingness to delve into financial analyses, and an appetite for risk that not all investors may possess. Moreover, remember, even Buffett's bets don't always pay off. Not all his investments have been winners, but his successes have more than made up for his failures. That's the potential advantage of a concentrated investment approach. As we conclude this discussion, it's worth noting that there's no one-size-fits-all strategy in investing. Buffett's method is one among many, and it's important to find an approach that fits your investment goals, risk tolerance, and level of expertise. He believes in betting big on companies you're confident in, rather than spreading your investments too thin. And with that, we wrap up our exploration of Buffett's take on diversification versus concentration. And that's a glimpse into the art of value investing, inspired by Warren Buffett. we've taken a journey through the principles that have guided one of the most successful investors of our time, principles that could help shape your own investment journey. We started with an understanding of what value investing is all about. It's not just about buying cheap stocks, it's about identifying companies that are undervalued, trading for less than their intrinsic value, and holding on to them until their true value is realized. We then stepped into the philosophy that has been at the heart of Buffett's investment strategy. Investing in businesses you understand, with strong leadership, long-term potential, and a competitive edge. And importantly, buying them at a price that makes sense. This isn't about chasing trends or making quick profits, but about understanding the value of a company and having the patience to wait for the market to recognize this value. We explored the concept of intrinsic value, a cornerstone of value investing. It's about looking beyond the surface, analyzing financial statements, understanding the business model, and considering economic factors. It's about gaining a deep understanding of what a company is truly worth. Patience and a long-term focus emerged as key themes. Value investing is not a get-rich-quick scheme, it's about playing the long game, holding on to stocks for decades and reaping the benefits of compounding returns and the growth of fundamentally strong companies. Risk management too plays a crucial role. As Buffett advises, it's about avoiding the use of debt to invest and ensuring a margin of safety. This means buying at a price low enough to offer protection against downside risk. And finally, we delved into the debate between diversification and concentration. While spreading your investments across a number of stocks is a common strategy, Buffett advocates for a more concentrated approach. Betting big on a few well-chosen stocks, companies you have confidence in, can lead to significant rewards. But remember, while these principles can guide us, it's essential to tailor your investment strategy to your own circumstances and goals. What works for one investor may not work for another. Your risk tolerance, your investment horizon, your knowledge and understanding of different industries, all these factors will shape your investment journey. So take these principles and make them your own. Learn from the wisdom of Warren Buffett, but remember to carve your own path. It's not about replicating someone else's success, but about understanding the principles that have guided their journey and applying them to your own. Investing is as much an art as it is a science. It's about understanding the numbers, but it's also about understanding the narrative behind these numbers. It's about patience, discipline, and a long-term focus. It's about managing risk and making informed decisions. It's about seeing value where others do not. So, as you embark on your investment journey, remember these principles. Understand the value of a company, be patient, manage your risk, and don't be afraid to concentrate your investments in a few well-chosen stocks. And most importantly, develop a strategy that works for you. Until next time, invest wisely and stay patient.